Inflation, I think, was the big story of this week. How did it affect investors' views of the marketplace?
So I think the new inflation news this week and in recent days has been that we see some signs that we may be seeing some peaking. We see it in inventories starting to build in certain sectors of the economy. We see it in some of the port log jams starting to ease a little bit. And we see it in emerging markets starting to tighten, which is a deflationary force that will affect the global economy. But I think for markets and for investors, the question really is, where do we see inflation a year from now? Markets always look ahead, and a lot can happen in a year. Think about last November. Think about last Thanksgiving, how different it was than what we're expecting this year with vaccinations and travel. And so a year from now, what do we think? We would use the word not transitory, but transitioning. Transitioning from the higher inflation that we have right now, 5 and 6%, but also transitioning from the very low inflation we had in the decade after the global financial crisis, which was less than 2%, to something more in between, 3 or 4. And what we need to remember, to your question about markets, is that markets have behaved very well with inflation in that range for most of our careers as investors.
Yeah, no question, they have performed well. So, John, do you agree with that analysis? Maybe we're transitioning not to 6%, but to 3 or 4%. And if so, what does it mean for your investors? And particularly, you need to worry about all those pensioners out there waiting to have their checks when they need them.
Yeah, I think we would have actually a very similar view. And I think probably every day this week we talked about inflation, and the word that kept coming up was transitory. And my question is always, what does transitory mean? It's not that helpful a word without a time horizon put on it. And I like the word transition. 6 months ago, we probably thought it was shorter. It would be a shorter horizon than it's turned out to be. We didn't anticipate all these COVID-related shocks to the supply chain. But we still do believe longer term that, and when I say longer term, I mean 12 to 18 months, we're going to get back to an inflation that is more similar to where we've been in the past. Really a belief that the supply chains will work through the issues and capitalism will find a way. And for our beneficiaries, we are really thinking about that from a 5, 10, 15-year time horizon.
So, Catherine, when it comes to the question of inflation, it's not just goods and dollars, it's also the Federal Reserve and how long they think they can put up with it. We had, as I say, toward the end of the week, 2 members of the Fed come out and say, you know what, we think we need to speed it up a bit. If, in fact, they do need to speed up the tapering and maybe the increase in interest rates, what does that do to investments?
So it really depends, right? Inflation can end a cycle if if the bond market responds. Inflation becomes a problem when the bond market responds, and we don't see that right now. We see a very gently upward sloping yield curve, which is what you want to see. It says that we expect growth, but we don't expect too much inflation, which would be a steeper curve. And so we don't see that right now. And I think an interesting question, in addition to the Fed, is how are people responding? Because consumers are 2/3 of the economy. And how are people responding? Consumers know they feel inflation every single day at the grocery store and at the gas station, and if they want to travel or go to a restaurant, we're all feeling it. But what are we doing? We're buying anyway. It's not stopping the consumer. And I think we have cranky consumers, right? We're all cranky about it, and that's probably a political issue, but it hasn't really become an economic issue. And consumers still have $2 trillion in bank savings from the stimulus. So it's not really changing consumer behavior, it's changing the consumer's mood.
So, John, this is a really important point, I think. It's not just a question of how much things cost, but are we growing overall? And as Catherine points out, we also had retail sales numbers this week, which were pretty darn encouraging, I must say. Is that an important indicator for you of the growth pattern for the economy and therefore potentially the growth of investment?
I would say we're still reasonably constructive on the economy. And maybe building on the point, longer term, we continue to see probably some headwinds to inflation, with demographics, with globalization being forces that will actually keep inflation in check over the longer term. We continue to see, continue to be constructive on the economy, but we're also a global investor. And I think one of the things that's interesting is to see the divergence in the global economy and the divergence in the global economy based on how different economies have approached COVID. And we're seeing it right now in Asia, in Europe, and in North America.
So, John, just to follow up on that, if I may, is there a better opportunity right now, particularly when you talk about valuations, overseas than there is in the United States? And I don't necessarily mean Europe. I may well mean Asia, maybe China, but Asia in general. Is the valuation more attractive there? Because let's be honest, the equity markets in the United States are pretty fully valued, are they not?
Probably some segments of the equity markets are pretty fully valued. The way we would think about it is we're a global investor. We've built out the capabilities to do lots of different asset classes around the globe, and capital should flow to the best opportunities around the globe. We're seeing a divergence, how countries went into COVID, how they're coming out of COVID, and certain asset classes are certainly presenting opportunities around the globe. We see opportunities in Latin America, we see opportunities in Asia, in India, but also see lots of opportunities in the US.
So, Catherine, back to you, the same question, sort of, where do you see full valuations and where do you see opportunities?
Yeah, so I'll go back to people, right? And how are people responding to what they're seeing in inflation in the markets? And, you know, what you see people doing, they might be cranky consumers, but they're actually very contented investors, right? Because we've seen, you know, the S&P 500, the NASDAQ, the Russell 2000, the small cap index all hit highs during the month of November. The NASDAQ hit another one today. And so we might be cranky about what we're finding in the grocery store and with our grocery receipts, but we're very happy when we open our 401k statements and our statements from our financial advisors. And in fact, what you see is that the individual investor is really all in this equity rally. We have seen what looks to be probably a record year in equity fund flows, a lot of which is driven by the retail investor.
John, I want to talk about one thing that happened this week, as I mentioned, which is the signing of that infrastructure bill. I mean, you have the advantage, I think, of being a patient investor as a practical matter. Does infrastructure offer an opportunity today that it didn't a year or two ago?
I would agree that signing of the infrastructure bill could be a game changer. Infrastructure for institutional investors around the globe it's a great asset class. It's a great asset class that it offers stable returns. And what infrastructure investors want to see is a pipeline of high quality assets. They want to see a pipeline of high quality assets where there's a stable regulatory regime. And with this infrastructure bill, we could see a lot of capital moving in and looking to participate in some of these projects. And I think a real opportunity to have public-private partnerships. We've been invested in the Transurban Chesapeake, Chicago Skyway, Puget Energy, and we see this infrastructure bill as something that could be a game changer.
Fascinating. And what about real estate, commercial real estate, back to the office? Are you invested in that as well?
Yeah, real estate's an interesting asset class. And in our portfolio, and thankfully a few years ago, we started to transition our portfolio into logistics, looking at the potential for e-commerce. We obviously never anticipated the pandemic and benefited tremendously from the kind of rise in e-commerce during the pandemic. We've been investing in logistics across the globe, Japan, Korea, United States. On the office side, I think probably still trying to figure out what the winners and losers are. And office is something that there is dispersion, but I'd say we're probably, for high quality assets, we're still investing.
So, Catherine, one more asset class, if it were, as it were, energy. There's been an awful lot of talk about energy, both because of COP26 and the climate issue, but also maybe some opportunities in energy, as we see, for example, almost a crisis in natural gas prices in Europe. What do you advise investors who are interested in energy? Is that a segment to get invested in?
So energy has become an increasingly small segment of the indexes, right? It's a smaller segment than it was in the past. And what we would say to our clients is, again, we have to look at what's driving the economy, right? And what is driving the economy is consumer spending, it's business investment, and you want to be invested in really a broad section of the economy right now, because we're seeing it across, small companies, big companies, tech companies. So you really want to have a diversified portfolio, and it will include some energy for sure.
You have the advantage of dealing with clients day in and day out. What's the number one question they're asking you right now?
Inflation. The number one question they ask us is inflation. Well, they feel it, right? We feel it when we shop. And what we say to them, I'll echo what John said, the deflationary factors that were in place before the pandemic are still here, right? Demographics. All of the major economies in the world are aging. The US, Europe, China, Japan. We're the young one on the block, but we're aging too. The average age in this country is almost 40 now. So that's still in place. Technological disruption is still in place. But the new thing that we've picked up during COVID is productivity. Productivity is a huge antidote to inflation. And we've recovered all of corporate America's earnings and then some, all of the US economy and then some, with 5 million fewer workers. Wow. That's productivity. And we see it across sectors. We see it in healthcare, we see it in retail, we see it in financial services, my sector. And we think that's going to continue, and we think that's going to help to contain inflation to that 2 to 4% range over time.
John, Catherine mentioned technological innovation, and perhaps a lot of that productivity in some sectors is driven by technological innovation. How about tech as an investment? Has it run its course? It's been driving the market for so long now. Do you see more opportunities in tech?
Yeah, we still do. We still see more opportunities in tech. We just participated in the McAfee take private. We're looking forward to kind of the growth of cybersecurity in the consumer side. One area of tech we're actually really interested in is technology to help transition the economy to net zero. Technology that's really focused on decarbonizing the economy. There's a real opportunity there.
So, Catherine, what about this ESG issue? Is there an opportunity there? I mean, because we hear about green mail, things like that. You can make mistakes there.
You can, but we know a lot more about ESG today than we did 20 years ago. It's not a brand new investing in strategy, not a brand new investment strategy. And what do we know? We know that it doesn't necessarily mean you will get lower returns. We know that we're coming out of a global pandemic where everybody is focused on values and what's important to them and legacy. And so we see that there's a lot more interest in ESG. And we also know, again, the individual is 70% of the economy. The individual is also 70% of financial markets today. If you include 401ks that we control, plus our personal savings, and individuals are increasingly interested in this as they learn more about it.
Yeah, it's fascinating. Also adds, as you and I talked about in the past, some volatility in the marketplace with all those individual investors.
Yes,
those
they tend to
investors.
be a little pro-cyclical as opposed to John, who's definitely counter-cyclical.
Exactly.
We want our investors to behave just like you, John.